Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with Mr. Jonathan Twomley. How you doing, sir?
I'm doing great, Michael. Great to see you again, as always.
Yeah, this is I'll say Merry Christmas. This is our
Oh,
first
yes.
our last video before, or Happy Holidays and all that.
Yes. Yes.
But
Absolutely.
one of the things that you teach, you mentor, you encourage investors to do, myself included, is to reach out and talk to brokers.
Yes.
Obviously, you're talking at bigger units and all of that, and I just love to hear what's going on today because it really feels like brokers they're probably stuck in a weird spot. Like sellers are, back to the future are going back, and buyers want the future, and it seems like brokers might be in a tough spot today, but maybe not. I don't know.
Well, yeah. So, I mean, listen, the market volume is down in the multifamily market, right? I mean, it's the end of the year. There's that, but this is not the reason.
Yeah.
Multifamily,
Yeah.
multifamily transaction volume is down because of the really rapid rise in interest rates. The problem is that the interest rates have gone up so quickly that the market really hasn't had a chance to adjust them. So what you have now, I was actually just commenting on LinkedIn about this, but what you have now is a situation in which, because of the rise in interest rates, your debt service, like the actual number of dollars that you must pay back for your loan, has risen a lot, right? And so
Now, just so we're clear, when you say a lot, are we talking 20%, 30%? What roughly?
well, actually, I don't. To be honest, I don't have the calculation on it. I mean,
Okay.
it's
It's double digits.
yeah. Oh no, I mean, there's been a dramatic rise in like how much money you must pay
Yeah, of course.
to service your debt. And so the thing is that at any given debt service amount, right, in order to get debt funding from a bank, if the interest rate goes up, right, if the interest rate goes up and it causes your debt service amount to go up, right, then your net operating income must rise 1.2x faster.
Oh, wow.
Than the change in your debt service in order for you to get the same amount of proceeds from the bank, right? So that is not happening, right? Your net operating income does not grow by 25% in a
No,
year, right?
not
So
normally.
this is what has happened as a result is that banks are offering less money to buyers, right?
Yeah.
Buyers need to then either get a big price reduction from sellers, or they need to raise a lot more capital from their investors, right?
And
Because they're
it's
not.
that decision right there. So there's three things.
Yeah.
Banks are lending less, meaning they used to do 70%
Well,
LTV, now they'll
yeah.
do 60.
Right. Not lending
Right.
less, but lending less against a certain.
Right. A certain
Yeah.
number.
Yeah.
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 Right. Then you have you have to replace that money somewhere. It's called equity.
Yeah.
So you have to go to LPs. And oh, by the way, LPs are scared because probably, I don't know what percentage, but I have friends who have syndications or
Yeah.
LPs in syndications. And I'm going to guess a third have already stopped distributions.
Yeah.
Right. Because they got to, they're probably being good operators, right? They want to make sure that they have a kitty or whatever.
Mm-hmm.
And then you have sellers who are stuck on yesterday's prices. Yeah, the broker's got to be in a really interesting
Yeah.
spot.
I mean, we haven't even gotten to the seller's piece of this yet, right?
Yeah.
But we're just talking about on the buyer's side.
Yeah.
They're looking at higher interest rates, which means they can get lower proceeds, which means either they have to get a price cut from the seller or they have to raise more money from their investors, both of which are hard to do, right?
Mm-hmm.
And they're also, the other thing that's going on here is we still don't know when these interest rate rises are going to end. So people don't really know like what exit cap rate to underwrite the deals at, right? So
now, let me ask you a question. Historically speaking, when you were underwriting a deal, kind of best practice was 0.5% higher than what you bought it, or no?
well, so the traditional rule of thumb for how to underwrite your exit cap rate is that you add 10 basis points per year of hold to account for the aging of the property, right? That's
okay. So a 5-year hold is 50 basis points.
Right. So, but what that assumes, which people don't really ever talk about, is that assumes basically like a static market, right? Because there's no fluctuations in cap rates. It basically assumes no market cycle, right? It's just,
I get you. Yeah.
yeah, it's just like, we're going to assume that every single condition of the market is exactly the same as it is today, because you really can't make any other assumption, right? Because you just don't know. I mean, that's not, well, I mean, I'll add some nuance to that in a minute. But that just assumes everything is the same. So what happens is that, you know, if you're at the bottom of the market, the bottom of the cycle, and you do your 10 basis points a year, that's being very conservative, right? Because chances are, if you're investing at the bottom of the cycle, you're buying at a high cap rate, and you're going to get cap rate compression over the course of the cycle, and you can exit at a better cap rate, right? But you're not going to underwrite that because you don't want to predict that. The problem is, when you're buying at the top of the market, chances are there is if you are not looking at the scenario in which cap rates decompress or go up before you sell, you're being very, very aggressive. But people don't think they're being aggressive because they're like, oh, well, I added the 10 basis points, right? 10 basis points per year may not be enough to account for that change in cap rate, because you're not only dealing with the aging of the property, but you're dealing with the change of the market cycle.
And again, this is why people have to do the work, right? So my stuff I was buying, it was always an 8 or 8.5 cap, right? I sold, I think, call it a 6.5, which again, historically speaking, was the stretched level. So that's why I got out in 2019. It went all the way to 4.5 or 4.8. Like, what are you guys doing? So that, in my opinion, couldn't go any lower. That was so bad. I mean, and it's going to snap back. And again, it will probably go the other way, right? It's going to go from 4.8 to like 9.
Yes, because what will happen is that, you know, there's going to be a period of time where the banks don't lend at all, right?
They're done. They're out.
And it's going to be, and so sellers are going to have to like lower their prices to try to get out. And you're going to have some, you know, situations where people can't refinance. They're going to get foreclosed on. Whoever is holding that paper is just going to want to get out and just get some of their principal back, right? And so they're just going to start selling. This is what you see every time. So you'll see cap rates, you know, kind of rise, maybe, you know, beyond the mean for at least a little while before it sort of tops out and starts going back the other direction. But anyway, so we've talked about the buyer piece of it, right? But now the seller piece is that the sellers either, I mean, they've started to adjust their expectations. Let's be clear. I don't think there's any sellers out there who realistically think at this point that they're getting their 2021 pricing, right? However, there are a number of sellers who need to sell at high prices in order to at least get their principal back out, right? And there's still sellers who are hoping against hope that they're going to get those high prices. There's sellers who, I mean, I've talked to some people who really still are buying into this Fed pivot thing. I still see this argument being made, like, oh, the Fed is going to have to lower rates again.
Easy money coming again.
I mean, listen, there may be some easing at some point, but it is not going back. Absent a major recession, like major recession, we're not going back to those low levels of interest rates in the foreseeable future. I hate to tell you folks this. It's not going to happen.
Not happening.
So even if there is easing, right, it's going to be a little bit of easing around the margins. But so sellers are holding out, and there's no clearing price right now. So because there's no clearing price, because sellers and buyers have very different expectations, transaction volume has really decreased, and brokers are kind of having a tough time. So I called a broker yesterday, and she was very happy to hear from me, I have to say. Like, you know, I mean, especially because I was talking about, you know, in this particular case, I was talking about trying to find assets for my Japanese partners who just have a very different kind of, their model for buying is very different. They're not hindered by a lot of these issues. And they can actually still potentially pay, you know, better prices than a lot of American investors can at the moment. So, you know, she was very, very pleased to hear from me and said so a number of times. but also, mentioned to me that syndicators are just having a tough time right now because it's hard to underwrite deals, but it's also very hard because they're looking at having to raise a lot more capital than they want to or than they can necessarily, because the sellers they budge somewhat, but they can only budge so far. And so you've got situations where deals are only getting funded 65% by the banks, and
A lot more equity to
the
raise.
syndicators have to come with that additional equity, and it's tough. So the market has definitely softened at this
Well,
point.
the beauty of all of this is, this time next year, you and I will be talking about deals we did because we stepped in. One of the things I'm seeing in my residential landscape is transactions are down 40%, first off. But second, I look at my market every day. I did for 3 years, and I wrote probably 250 offers and got like 3 counters.
Hmm.
In the last 7 or 8 weeks, I've closed 2 deals.
Wow.
Right between Thanksgiving and New Year's. I tell people every year, and I told them this year I'm going to do it again. And we found motivated sellers that had to get out. We got them for roughly 28 and 30% below list price. And they're great deals. And, and again, it all comes down to doing the work. So I bring this up because I think it's coming for us. And I tell everybody it happens in residential first, multifamily's coming. And that's why I will probably 1031, just like I wrote about in my book. I went from 8 houses to 80 units, and I got a lot more houses today. So there'll be an opportunity to 1031 next year, year after, and it'll be a lot of fun. I'll get my biggest building. I can't wait. I'm going to just keep putting it out there. So, Jonathan, where can people find you?
Yes, if you would like to join me as an investor on this journey, please Google Two Bridges Asset Management LLC and fill out the investor form that you will find under the investor tab. That will get you onto my list. And if you want to set up a call with me, I'm really happy to get on the phone with you or do a Zoom call like this and just answer whatever questions you have about how you invest with me and so what I do. If you are interested in learning how to do this stuff yourself, a great way to start is to go grab this free download on my website. Go to apartmentinvestorsclub.com. You can get this ultimate checklist, which is a guide to doing your first 100-unit deal with other people's money and getting paid to do it. Basically walks you through the whole process of syndicating deals from, how to choose a market all the way through to scaling a business and every single step in between, all in one checklist. So you can just walk through it. So that's absolutely free at apartmentinvestorsclub.com. And while you're at it, you should go and join my Facebook group, which is also called Apartment Investors Club, and come and just ask me questions. I'm happy to answer your questions. And there's some free video content in there, which is really good. People have really liked it. And just go in there and watch those guides. Again, it's a very good companion to this checklist because it covers a lot of the same ground. If you're one of those people who learns best by absorbing information in 2 different formats, right? This will really help you reinforce, that ground, that sort of basic knowledge that will just help you get started. It's just a really excellent starting point for how you buy multifamily deals, whether you want to syndicate them or not. So please go and join Apartment Investors Club on Facebook.
Thank you so much.